Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by David Cunningham, who's the CEO of the Cooperative Bank. Welcome in, David. Thanks for joining us.
Thanks, Gareth. Pleasure to be here.
Now, look, it's been a very interesting year in banking, and obviously there's a bit more to come still. I guess if we kick off and have a chat about what's going on in the mortgage market, the home loan market at the moment, we've seen the big banks with some aggressive rates below 4%. They're sort of retreating from those now. What's it like at a bank like Cooperative Bank, one of the smaller banks in New Zealand, when you see the big boys really going for it like that?
Yeah, well, what drives the margin is really for us is term deposit funding costs, because the marginal dollar of lending comes from a term deposit. So what we've seen is term deposit rates hold up and yet fixed mortgage rates sort of come down. So it's easy to sort of stand back and go, margins are wide. Well, actually they're not. They're probably as narrow as they've been in probably 2 or 3 years. So it's tough for us. When we put the current lending rates below 4% from some players through our return on equity models, we find that we just don't really want to compete at that level. So, we pick and choose our battle. So it's, it's sort of tough, but I guess we look through the long term and our view has been that 4%, sub 4% mortgage rates are unsustainable unless something gives like term deposit rates, and they haven't. If anything, the competition's gone up there. So it's sort of a real margin squeeze sort of thing going on at the moment. Can
you give us any specifics on just how tight margins have got?
Yeah, well, look, we've seen plenty of deposit rates for 6-12 months terms around that 3.50, even 3.6%. And when you're lending at 3.95% on 1 year, or even 2 years, 35, 40 basis points is incredibly slim. Over time, you tend to see that spread at about 1%. So, I've sort of seen that competition and I stood back and said, look, it's unsustainable. I think probably what we've just seen, sub 4% interest rates on mortgages, is possibly the generational low.
The generational low.
Yeah, I reckon. Unless term deposit rates were to fall to say 0.5%, in which case we'd see those back there. But I think it was sort of just this flurry of competition, maybe prompted by the conduct and culture review. It was sort of a way for banks to sort of show that competition was alive and well. But I sort of stand back and go, well, interesting, but how many people actually benefited from those really low rates? Perhaps, a few tens of thousands of people at the absolute most. So so it's been an interesting time, but it's, from my perspective, it's good to see those rates coming off because I think they are unsustainable.
So that's interesting. You're talking about generational lows. So I imagine then your outlook for next year is that mortgage rates are probably going to rise a bit? Yeah,
well, it looks like the OCR is going to remain reasonably unchanged over the next year or two. We've certainly got a more dovish Reserve Bank governor in Adrian Orr, so I don't think there's a lot of upside in the OCR. But what I do see is margins restoring to sort of more sustainable levels in terms of that funding cost versus the lending rate. So I think probably where the mortgage rate settle, I'd sort of say around that 420 to 440 level for 1 and 2 year terms is what we're going to see over the year ahead.
Okay.
So certainly up from the lows of 3.95 we've seen in the last 2 or 3 weeks.
I'm sure it's going to be interesting to watch as ever.
Yeah.
I guess moving on to more other industry specific issues, we've had this Reserve Bank and Financial Markets Authority conduct and culture review of banks recently. Now, obviously that's followed the Royal Commission in Australia, which has dominated the news flow over there all year pretty much. You're going to be getting some individual feedback from the regulators on that. Now, just wondering whether you've got that yet and what you're anticipating from that.
Yeah, so yes, we have. We can't talk about the specifics for us, but I can talk about the industry sort of perspectives and what I think that means. So we've certainly had all that feedback. The two documents were really the FMA Conduct and Culture Review alongside the RBNZ, an individual letter that came with that, and then the same on the FMA's Incentives Review, which was a long planned review, which happened to coincide. So it was sort of quite good that they came together, and then an individualised letter on that. So I can sort of talk to the industry sort of type perspectives and what I think it might mean.
Yeah. Okay. Well, what will it mean?
Well, I think the key point was that the review didn't find evidence of widespread poor conduct across the industry, and the RBNZ and FMA really positioned that as potentially good luck rather than sort of good management, and that a lot of the processes that you'd expect to see to ensure good conduct occurs in terms of management oversight and particularly board of directors oversight weren't there to the extent that they'd expect to see. So no instances of poor conduct evidence, but the risk that they would occur. And so I think the theme of that piece of it was that all those controls and so on, that visibility, the culture that the board and management sets for staff need to change or need to sort of be enhanced. So that was sort of the one thing. The second thing was really on incentives, which I suppose you'd say that was probably almost like the big news from both reports, because whereas in Australia we've seen quite a lot of work done on incentives, so the Sedgwick review of probably about a year ago now, which found that incentives were too big a part of retailer remuneration and were potentially driving poor practices, and recommended that sales should form no more than 30% of the scorecard, which might drive incentives for retail staff. Whereas in New Zealand, the FMA and RBNZ basically said, thou shalt not have sales incentives. If you do, we'll sort of name and shame you is probably the way to describe it. You know, we'll disclose who hasn't removed sales incentives down to zero, literally, and if you haven't, then there'll be a sort of what have you done to strengthen controls. So arguably, sales incentives can remain if you've got really good evidence of controls. But I think it's sort of quite hard to fight that wave actually. So I think what we're going to see and have already seen to an extent is the total removal of direct sales related incentives across the banking industry. And that's got some pretty big connotations for certain roles in banks.
And so, I mean, where does the Cooperative Bank currently sit in terms of sales incentives?
Yeah. So, look, I've when I arrived at Co-op Bank sort of 5-6 years ago, sales was a dirty word. Interesting. And I think that culture of doing the right thing for customers without a commercial discipline was really unhealthy. And so one of the first things I did was start to measure sales. And it was sort of interesting because people said, whoa, our sales staff must hate that. And actually our sales staff loved it because people like to be measured, don't they? So, really good insight in terms of it created a really healthy commercial focus. And what we had was team-based incentives rather than individual incentives. So the door opener was always you were performing and compliance was good as an individual, but we rewarded the team. And so we found that really, really effective as a way to get the right customer outcome, because the team sort of self-disciplines and sort of raises the bar. So I think that was perhaps unique in terms of, everyone in the team would get the same reward in the branches that were performing. But what we've started to do is sort of soften that over time anyway and start to give everyone in the bank an incentive so long as they're at that minimum performance level. So I suppose where we're going now is that, we've got the directive, thou shalt not have incentives, and so, we'll sales-related incentives. So we're looking at sort of what replaces that. And I think now we've created that more customer-centred commercial focus, I think it's actually a good journey for us. So I sort of stand back and go, in some ways, it's sort of frustrating that we've been told what to do, and I don't see that happening in other industries. But equally, in some ways, it's actually a really good outcome for us, because I think it continues our journey from becoming very commercial to actually refocusing back on just ultimately you're in it for the customer and being customer owned. That's who we are. Everything we do is about benefiting our customer. So I sort of stand back and go, it's sort of an interesting approach in terms of thou shalt not have sales incentives, but in some ways I'm really encouraged in terms of how we can really embrace that and take our bank on the continuing journey.
So what do you think you will replace sales incentives with?
Yeah, we're playing with that. We think there's a sort of a two-step journey where, you can look at balanced scorecards, but we've done a lot of work on culture and what drives culture, and things like balanced scorecards, where you've got things like customer experience and, are you doing right by your customer and delivering to their financial well-being, which are things that the FMA and RBNZ have talked about. Things like some sort of the experience a customer has when they have the interaction with a staff member, so the quality of those conversations and so on. So there's that sort of balanced scorecard stepping stone, but the problem with balanced scorecards is that nothing really counts all that much. You can fail, be not so good on something, and the thing that you're really good at doesn't really lift the overall, so you tend to get this just squashing everything down to the average sort of thing. So we're sort of looking at perhaps an interim step over in the year ahead as we move away from a scorecard that is sort of balanced with a reasonable focus on sales to something that perhaps is very left field in terms of, like learn to earn is sort of one of the ways to think about it. So the more investment you as an individual make in your learning, which enhances the quality of the conversation with the customer, the more we'll pay you, or the more the incentive might be. So, we're really thinking right out there in terms of how we might use incentives. Because I do like the concept of a small annual reward for our people, as opposed to just lump it into salary. So, things like that. So we're working with some really interesting companies in the US on this stuff. So yeah, it's fascinating sort of space.
It'll be interesting to watch the developments in that area. Yeah. Now, I guess one of the issues that has been raised through the conduct and culture review too is the competitive landscape in banking in New Zealand, or lack thereof, depending on who you talk to. What's your take on just how competitive it is in banking in New Zealand? Because I know, for example, with the Commerce Commission recently getting these new market study powers, there's some talk that banking might feature there in the future.
Yeah, well, that's particularly interesting. When the petrol industry market study was announced yesterday, I was sitting in my car listening to it, and I was thinking, next stop, credit card market. Because I think that's a real area of customer harm, to be honest. And so if I think about the conduct and culture of banks and doing right by customers, how is it that $4.5 billion of funds of borrowing is via credit cards at an average interest rate that New Zealanders are paying of 17.9%? Why isn't it that banks are saying, hey, you should not be in that product, we're going to move you to 13% sort of product? So as you know, we've got a credit card at Co-op Bank, which the interest rate's 12.95% on everything, be it a cash advance or whatever. If that $4.5 billion was at that rate, that's $200 million. So I stand back and go, that's the harm that banks are doing to customers. And so I think there's a lack of competition in areas like credit cards in particular. It's at the margin. It's the 0% deal for a year, or the 0% for zero fee for 6 months. It's that sort of thing. And so it's a bit like fixed rate mortgages. Banks compete at the margin to win that next deal, but actually the bulk of other customers are sort of helping subsidise that. So I sort of stand back and go, there's some real competition in things like term deposits and fixed rate mortgages. Outside of that, savings products, transaction products, the fees are pretty competitive, but in terms of interest rates, pretty similar and arguably not all that competitive. Person lending, credit cards and the like. So there are a couple of pockets of high visibility, deep competition, but there's plenty of other places that are sort of the gravy train, I suppose you'd call it.
Yeah. Be interesting to see if anything happens there. Now, the next topic I was keen to talk to you about is bank capital. Now, obviously, the RBNZ's had this review of bank capital adequacy going on now for probably best part of 2 years. Adrian Orr has made some interesting comments, as he tends to do, talking about how the Reserve Bank's looking to impose capital standards on banks that match the public's risk tolerance, and saying that bank capital is the number one safety valve for citizens of a country. Very interesting comments, and obviously they've got this consultation paper coming up shortly on capital ratios. What's your perspective? Obviously as a smaller bank, you don't use the internal ratings model that the Big Four use, which does give them advantages. So what are your hopes and expectations from this final part of the capital review?
Yeah, well, I think you interpret what Adrian said, and I'd sort of say, AKA, banks need to hold more capital, and what I'd say is actually banks in New Zealand, the big banks, have materially lifted the capital sort of holdings to levels that are surprisingly high. So, we've got the big banks at 15, 16% capital ratios. I think that's simply because they know they're going to have to hold a lot more capital against, in particular, residential mortgages. So, for example, our average residential mortgage book, we hold 38%, they're 38% risk weighted. Amongst the internal model banks, the range is something like 19% to I think about 31%. Now, if they were at 35%, the return on equity that they'd be earning would be materially lower. So, of course, I'm going to try and defend that use of my internal model, but I think what Adrian's saying is actually those numbers have to be higher. They need to be nearer the standard model that we're forced to use, that we use. So I think really that's an inevitability that in the next few months we'll sort of see the releases from the Reserve Bank requiring those internal models to, maybe they're weighted at minimum of 80 80% or something like that of what their standardised model would use. And for us, that's really good, because a good example I've seen in the last few days is one of the big banks, if it writes a mortgage, with its much lower capital holdings, then its return on equity would be 18%. For a smaller bank, there are a few of us, it's 6%, and the difference is the difference in capital, but also the efficiency difference. So, fair enough on the efficiency difference, but it seems really unfair to us. And actually, you've got to stand back and say bad for New Zealand, because it sort of enables the big Australian banks to continue to dominate the mortgage market, to price lower, which is good for the customer. So, there's a sort of a trade-off there, good for the customer, but actually bad for New Zealand in terms of New Zealand Inc. struggles to compete. So, I think a levelling of the playing field, which is pretty unlevel at the moment, is a really fair outcome and a really appropriate outcome. And I think that's what Adrian's sort of saying, is that actually more capital in banks is a good thing. So for us, I think we already hold high levels of capital. 16-17% is sort of our target range, and so it's sort of more about the large Australian banks that would hold more capital. Yeah,
it's an interesting point about the potential impact on the customer, because I think the level playing field argument that you make is a pretty sound one. I think for any industry, you sort of want to have a level playing field for the different competitors in it. But that potential impact on the customer is interesting. I mean, what do you think might happen if the big banks are forced to hold more capital? That mortgage rates might go up, deposit rates might be impacted. I mean, what are we talking about?
Maybe not, because like I said, we've already observed banks holding significantly more capital. So I think we've seen most of the big banks increase their capital levels maybe by couple of percent over the last year or two, and so I think that's preparation for what's inevitably coming. And so arguably they're probably using a high capital weighting in their internal models anyway, so arguably we've already seen some of that impact. So it might not be bad for the customer ultimately. So the potential's there in theory, but in practice I don't think it will necessarily have a profound impact.
Okay, well, look, we'll have to watch this space on that one.
Yeah.
Look, thanks a lot for that, David.
Yeah.
That's David Cunningham, who's the CEO of the Cooperative Bank, and I'm Gareth Vaughan at interest.co.nz.